Our next speaker, we've already heard a little from earlier this morning. He has a long and distinguished resume as a geo and executive in resources around the globe, with names like BHP, Billiton, Kinross, and Hunter Dickinson. As I mentioned yesterday, he's the immediate past president of a little-known Canadian get-together called PDAC. But in addition to that, he's also the former president of the Canadian Institute for Mining, Metallurgy and Petroleum and the Mining and Metallurgical Society of America, amongst many, many other accomplishments on his resume. Oh, and by the way, he's also director of ASX-listed Cardinal Resources, which is what you'll see listed in your program. To help us understand securing the future, please join me in giving a very warm welcome to Mr. Bob Shafer. Bob.
Well, first of all, thanks very much for the generous introduction. I appreciate it a lot. There's, I think, a little bit of exaggeration, but I'll take it. Also want to thank Cardinal Resources for sponsoring me to be here today. And I'll talk slowly so I can overcome the language barrier we have between us. Okay, so we all know that exploration is a cyclical business. It's plagued by inconsistent funding. It's plagued by movements in and out, not just by companies, but by individuals and so on. We're looking at consistent depletion of resources, fewer exploration geoscientists that have the drive to be an exploration person. We're also plagued by fickle investors. We've got a poor public perception, and we've got increasing regulatory environments that are oftentimes created by people that don't really appreciate what our industry brings to their quality of life on a day-to-day basis. So with this background, today I'm going to talk to you about kind of these topics that are shown up here on the slide and talk about the challenges that we're facing in the business of exploration. So in a short period of time, I'll look at these. Let's see if I can keep it together. So why do we explore anyway? It's really pretty simple. If we want to have an industrial world and we want to have a world where people have a comfortable quality of life, we've got to have minerals in order to support that style of living. And to do that, we have to have continuous discovery to replace what's been diminished, and we have to make those discoveries happen on a consistent basis. My friend Richard Shoddy made a statement last year stating that basically we're doubling our consumption of produced metals now every 20 to 30 years, and that goes for the entire span of commodities. And so here's why we're in a crisis. In recent years, exploration has shown itself to be a really poor investment. Beginning about 2007, a lot of money was thrown at exploration with the exuberance of the super cycle and so on, and you can see what happened. Too much money went in, not enough was found with it, and as a result, the value of the discoveries that were made and the number of discoveries that were made fell off dramatically because money was just being poured down a hole. It was a value destruction situation, and the investment public does have a long memory. And they saw we gave you $15 billion over a few years, and there wasn't enough coming back to satisfy us. And I'll show you that in spades in a little bit later. Okay, here's another kind of a little bit of a case study looking at the situation for copper. It's similar to something that was said by Dr. Richard Hillis Tuesday of this week. Basically, up till this point in time, we have consumed about almost 700 million tons of copper through all of history. Over the next 25 years, given a very conservative growth rate, we're going to consume more copper in that next 25 years than we've produced in all of history. That's a pretty amazing statistic. It's very frightening. The data comes from the USGS and Brook Hunt. This situation is not just common for copper, but we're seeing it with other commodities as well. So now we've showed that our industry is not efficient in the way it spends its money in making discoveries, and yet we still need to meet the demand for those commodities. Probably now with less money available to us, fewer people making the effort to carry out discoveries. I mean, there was a true conscious effort by major mining companies to abandon exploration to the junior sector because they saw it to be a cost center that they no longer wished to support. That started in about the year 1990. How do we improve our discovery performance, especially as the explorer and the miner become less cooperative and we have fewer early discoveries that these rarely exist anymore because there's less money going in. So we have to look at how do we create greater efficiencies in our use of money to find the commodities that we need and how to improve the value created by those discoveries. Okay, here's a couple of slides. One I think we saw yesterday. We all know that base and precious metals are being demanded on a consistent basis. But this slide, which comes from Rio Tinto's annual report, shows that with the evolution of the electrical society, there's a whole number of commodities that are also going to be in high demand. In terms of value, as I mentioned in the panel discussion, many of these commodities have very shallow pools. You can overwhelm the market very quickly if you have too much discovery, but at the same time, they need to be found, and we need to replace those that we've consumed. On the second slide, under value created, I really want to draw your attention to the circled area. The bar graphs just show the value created by discoveries over the past number of years. The tier 1 discoveries actually make up more than 50% of the value of all those discoveries, and those amount to, on average, about 10 on an annual basis out of 60 that are made. So we need to find more tier 1 discoveries as well. Okay. Yes, I'm right on schedule. Because of the opening of new exploration terrains, such as Latin America in the 1980s and 90s, Asia in the 1990s and early 2000s, with the advent of new technologies in geophysics and geochemistry, with deeper drilling as well. And obviously we had more spending along the way. About 50% of all discoveries through history were made since the 1970s. That's about the time that I've been in exploration, so thank you very much. I participated in a lot of that. I've got 4 gold mines that have gone to production that I've been involved with, and I'm working on now a major nickel deposit that's in bankable feasibility stage as well. Looking at the last decade, so where are the best places to spend your money if you're going to get the best bang for your buck? Annually, over that 2007 to 2017 10-year time period, we've spent nearly $200 billion in exploration. Yet, if you look in the third column, I'm sorry, there's a missing slide. Okay, we'll go to this one. I don't know how this happened. This gives you an idea of the breakdown of discoveries over the time frame. The blue line at the bottom represents the tier 1 discoveries over time. And you can see on average, it works out to be 10 to 12 per year. The red line illustrates the tier 2 discoveries, and the gray line are other significant discoveries beyond that. You can see we make about 60 important discoveries over a course of any given year, but you also note about 2012, the cliff drop-off in terms of what has been discovered. Yes, we were in the polar time frames of no money for exploration after the global economic crisis and so on, but it also was a knee-jerk reaction to the excessive spending that went on during the super cycle activities. Okay, this gets me back to somehow these got out of order. Let's see. So what commodities do we look for? We've spent about $200 billion over the past decade looking for these various commodities. 81 important discoveries were made, and of that, the value created was only about $90 billion. That's only a 47 cents on the dollar return on the investment. You can see why our investors are not pleased with us. And if you look at this a little more closely, you'll see that most of the commodities cluster right around that 45 to 50 cent return on investment. given the time frame, I wouldn't want to be an investor in diamond exploration. The return is only about 20 cents. This is the one that I missed before. So where do you go to look for these things? Well, Africa, Southwest Pacific, and Canada seem to have the best ratios for return on investment. You can see the numbers balance out at the bottom again. But Australia's not doing badly. Canada's not doing too badly. You probably want to stay away from Latin America. It seems to be depleting itself. Okay, I showed you, I think you've seen this slide before, if not today, yesterday. The bar graphs illustrate the value of discoveries made over time. The red line is exploration spending since about 1970. You can see in the year 2007 approximately, the amount of money spent in exploration actually exceeded the value of the discoveries that were made. I created a regression line trying to express this in terms of what's an efficient exploration budget for global exploration. And if you look at that line, it suggests at this point in time we ought to be spending perhaps $8 to $10 billion a year globally on mineral exploration activities. So that $15 to $20 billion number was beyond what could reasonably be spent. Okay, these two graphs are actually based on the same data set. And what it's showing is who's making the discoveries. Is it the majors? Is it the mid-tiers? Is it the junior sector? The blue represents the major discoveries, and you can see going from 1975 to present, there's been a more or less continuous decline with bigger drops coming since about 1990 when majors started deferring exploration to the junior sector. So, similarly, the big green area are the discoveries made by the juniors. If you look at the arrow on the other graph, that points to the year 1990. That seems to be the turnover year in which junior explorers actually started making on a consistent basis year in and year out more discoveries and greater value discoveries than the majors were doing. And that's continuing to today. So I guess no matter who's making those discoveries, we need to answer the question, is exploration as a business finding enough material to satisfy our industrializing world? Again, these are some graphs that were, although the data comes from Brooke Hunt and the U.S. Geological Survey, they were compiled by Richard Shoddy, and I think they express something very neatly. The red lines illustrate the annual consumption for each of the various metals shown up there, gold, copper, zinc, and nickel. The bar graphs illustrate the amount of metal consumed each year along the way. The dashed lines represent basically a linear extrapolation as to how much metal is going to be consumed between now and the next 25 years. I mentioned that it has been mentioned, particularly yesterday, that metal consumption is going up by about 3.2% year compounded annually right now. Those extended lines are only being extrapolated at a 1.8% percentage rate, compounded percentage rate. But you can see that the gold, the zinc, and the nickel, we're looking at crisis in the not too very distant future. Copper says it looks like we're going to be in equilibrium, but I think with the coming of electrification and the electronic technologies that are coming along, that's a very conservative graph going forward, and we're probably looking at something much more radical than that. And so we probably will be seeing shortages there as well. Okay, let's make sure. It also takes time to go from discovery to making a mine that produces the metal. Generally, from a discovery hole to a first resource calculation is a 2 to 3 year time period. So right off the bat, you're right at the beginning, but you're already 2 years behind the ball. Then it takes time for engineering, for delineation drilling, for metallurgical studies, environmental studies, and perhaps most crucially, your relationship developments with communities and governments. So essentially from discovery hole to first production, we're looking at 12, 15 years for almost every type of commodity we can look at. So there's a big lag time as well. So even if we had a plethora of discoveries over the next 3 or 4 years, it's still going to be almost 15 to 20 years before we start seeing them impacting the market. So I'm going to give you some preliminary conclusions here. Historically, we get 60, perhaps as many as 80 notable mineral discoveries made annually in the world. Most of these are run-of-the-day mines that create good cash flow, but they're not world-class. We get about 12 world-class discoveries made annually, but in the last decade, it's averaged only about 2 to 3. The importance of the junior sector in terms of exploration discovery has been increasing dramatically since 1990. Unfortunately, the return on investment to exploration has been dropping. We're no longer seeing a one-to-one return on exploration money. It's more like 50 cents on the dollar. Then the lag time from discovery to production is also increasing. Currently, we're looking at 10 to 15 years to go from discovery hole to first production. We're not adding enough sufficient metal inventory to maintain our capacity for continuous industrial development, particularly as it comes to zinc and nickel. Copper's going to be challenged as well. Gold also. So based on this, my belief is we need to change the business paradigm. There's something inherently challenged in the way exploration is being funded and carried out now. I think I showed you the slide a little bit earlier. I've added a couple of circles to it, illustrating what's driven exploration and discovery over the past 150 years. If you look, 1880 to 1910, that was really the opening of frontier areas across the world, Australia, Africa, North America. There always seems to be a drop-off during the years of global conflicts, world wars. So you're looking at the time frames of World War I and World War II, Korean War as major dips in discovery and development. The Great Depression looked to be a time for important discoveries. At least in North America, we attributed that to the fact that so many people lost jobs that people were turning to prospecting, basically. That was a way of putting food on the table by making discoveries mostly for gold in the West. Then, right after the Korean War, the great discoveries of the world came from corporate exploration activities, the coming of and the really establishment of real science going into discovery and not prospecting. So you had the CRAs, the Rio Tintos, the Kennecotts, the Anacondas, the Asarcos, all contributing. And that's what led to the boom of discovery that started in about 1950 and continues today, although it's fallen off in recent years. So as we discussed, the lack of performance and the inefficiencies of the recent exploration business activities, we need to find a way to improve that. Our investors are exasperated. We need to find a way to get consistent funding into exploration. So there have been over time several exploration business models that have come about. You've looked at typical organic growth through exploration. Companies had their own exploration divisions that went out, and that sort of went out the window in the 1990s from the majors' perspective. What I call the discovery predator model. The junior sector finds things, a bigger company takes them out, most oftentimes in a hostile environment, and that started really in the mid-90s and continues today, although not so much. Now, in recent years, the prospect generator model or the exploration accelerator model has evolved, in which it looks more like a joint venture in which a relationship is developed between a junior explorer who becomes somewhat of the exclusive provider of exploration projects for a major or a mid-tier by way of specifying a commodity and specifying a geographic area. What we really need is what I'm calling a sustainable discovery business model, or perhaps a collaborative model. People, funds, and skills need to be leveraged to achieve exploration success. Best practices in operations, best practices in environmental stewardship, and best practices in community relationship developments all need to be brought into the science of exploration so that it's a multitasking activity all the way along. We need to, and the reason for bringing in these softer areas is because we need to look for ways to avoid the artificial delays, what I'll call them, that are created by protests socially for mining in many parts of the world, government regulations, the permitting delays that go on. If you establish your communications early on before you get out into the field for the first time, not only does the community you're working with know what to expect, but the government knows you're coming as well, so they're prepared as well. So we need to have better collaboration, not just among industry members in terms of the prospect generator type models, but also collaboration between the players in the field with the communities, with the broader stakeholder bases, and with the government. Also, I think if we're going to go to a model like this, if delays are created or even a cancellation of a project for some reason because it's, even though it's shown to be economically viable, but for some reason it doesn't fit with the current social values and that thing is shelved, there needs to be compensation made for that as well. Because if we did this properly, it was an acceptable idea in the beginning, the change in mind, there has to be a payment made for that the change in mind and values. So how would you look to structure a sustainable exploration business model? Well, mining companies want to mine, exploration companies want to explore, but they also want to have consistent funding for their activities because they're generally not a revenue generating activity. Governments and communities want to know what to expect with what you're doing, and they want to have their needs addressed early on. So if you can create a well-structured joint venture that brings in all four of these components together, the company, the junior companies, the producers, the communities and stakeholders, and the governments, you should be able to put together a business strategy that satisfies all. The basics would be the relationship between the major producer and the junior explorer. You need to define the commodity, the area of interest, the amount of money being spent, and it's a leveraged situation where early on the explorer's money is spent in large part through corporate financings and that sort of thing, but it's leveraged by supplements from the major. Moving forward in the discovery process, you get to a PEA or PFS, the shoe goes to the other foot. Now the explorer gets carried for a while, such that the major company puts up the largest majority of the funds and the junior is leveraged in that fashion. When you get to BFS, it's treated as a business joint venture, and therefore it's financed as a project, not each individual side of the equation financing itself. If the major decides or the producer decides it wants to take out the junior company, that's fine. You pay a fair price and you retain a royalty, so there's a continuity of funding that goes to the discoverer along the way. But again, everything in an idealistic world would all manage to come out in the wash. And so for some final comments, the risks of exploration and production need to be leveraged. It shouldn't be all on one side of the equation or the other. I say nose in, hands off. When the exploration's going on, yes, the producer who's put some money in to help leverage the explorer observes, makes suggestions, but doesn't interfere with the exploration activity. On the other foot, when it comes time to putting together the BFS, yes, the junior's there on an advisory role. They know what's going on. They see where the budgets are and so on. But they're not telling the major how to do his business. So basically, the discoverers and the producers establish a long-term relationship in which project funding is established, collaborative relationships are built, and joint oversight committees work together to make things move forward in a positive fashion. It means that the discoverers have access to developers' technologies, and developers have access to the creativity that the explorer has in its portfolio. All participants tend to do what they do best. The discoverers find, and the producers mine. And with success, governments are satisfied. They're getting the tax revenues they want. Communities are getting the commodities they want. They're getting the employment they want. And they're getting the protection of their living areas carried off properly. And with that, it's an idea, but I'm happy to take some questions and talk about it.